What if the UK housing market is heading toward its most unpredictable year in over a decade? Headlines talk about stability, forecasts point to modest growth. Yet beneath the surface, something entirely different is taking shape. A combination of higher borrowing costs, stretched household budgets, policy uncertainty, and fading confidence is slowly reshaping the foundations of the market. People are beginning to question whether 2026 will be the turning point everyone has been quietly avoiding. Before prices shift, before sentiment changes, and before the pressure becomes visible, it's worth asking a simple question. Are we ready for what comes next? Number 1. Stretched affordability, even with slower price growth. Despite the recent cooling in the housing market, affordability across the UK remains under severe pressure, creating a major risk factor for a potential 2026 downturn. House prices sit close to historic highs, while wages have not kept pace with the rising cost of living. Many buyers rely on longer mortgage terms and smaller deposits to make purchases viable, which leaves very little room for financial setbacks. When households commit such a large share of income to repayments, even slight economic changes can create stress. This imbalance acts as a foundation for wider instability across the housing system. The affordability squeeze is visible in both new buyers and existing homeowners, shifting to higher mortgage rates. People coming off older fixed deals often face repayments that are hundreds of pounds more each month. This creates financial tension at a time when energy bills, food prices, and general expenses continue to strain budgets. When everyday spending absorbs most of a household's income, the ability to manage unexpected expenses becomes limited. A financially stretched population reduces market momentum as fewer buyers feel capable of committing to large, long-term borrowing in an uncertain economic climate. The cumulative effect of these pressures means stretched affordability is not just a short-term concern, but a structural issue shaping the 2026 outlook. Buyers already operating at the edge of their financial capacity are vulnerable to economic fluctuations, such as job changes, slower wage growth, or adjustments to interest rates. When large numbers of households face this vulnerability simultaneously, the market becomes sensitive to shifts in sentiment. This makes affordability a key driver, capable of transforming a mild slowdown into a deeper decline, especially if broader economic conditions fail to improve during the coming year. Such patterns place continued pressure on stability across multiple housing segments in the UK. Number 2. The mortgage refinancing cliff in 2025 to 2026. A major pressure point building beneath the UK housing market is the large wave of mortgage deals ending across 2025 and spilling into 2026. Many homeowners locked in extremely low fixed rates during the pandemic, and those deals are now expiring. When these borrowers refinance, they face rates that are significantly higher than what they have been paying for the last few years. This transition can create sudden jumps in monthly repayments, placing households under financial strain. As this refinancing wave grows, the number of people facing difficult choices may increase, influencing overall housing stability. The challenge intensifies because a meaningful portion of homeowners delayed refinancing while hoping interest rates would fall faster. As a result, pressure has shifted forward, concentrating more stress into late 2025 and throughout 2026. When fixed deals end, households must adjust instantly to new repayment levels, which can reshape family budgets. Rising payments often lead to cutbacks in essential spending, reduced savings, and difficulty managing other debts. This shift affects not only individual households but also broader economic activity, as spending patterns change. A collective tightening of household finances can weaken market confidence, slowing buyer demand. The refinancing cliff becomes a risk for the housing market when many households encounter these difficulties at the same time. If significant numbers of people struggle with repayments, some may choose or be forced to sell. When multiple sellers enter the market under pressure, price reductions become more common, especially in areas with already weak demand. Even a modest increase in distressed selling can influence local pricing trends and shape wider market sentiment. This creates a vulnerability for 2026, because the scale of expiring fixed-rate deals and the higher cost of new mortgages place many homeowners in a financially sensitive position, amplifying the potential for downward pressure on property values.
Number 3. Higher for longer interest rates affecting buying power.
Interest rates remain one of the most influential forces shaping the UK housing market, and the expectation that rates will stay higher for longer is a central risk heading into 2026. While rates have eased slightly from their recent peaks, they remain far above the ultra-low levels that buyers grew accustomed to over the past decade. Mortgage deals offered today reflect this new environment, with typical fixed rates still sitting in ranges that significantly increase the long-term cost of borrowing. When the cost of finance remains elevated, the ability of buyers to stretch their budgets becomes limited, reducing demand at key price points. This shift marks a major departure from the financial conditions that supported rapid price growth in previous years.
Buyers can no longer rely on cheap borrowing to offset high asking prices. Instead, they must evaluate properties based on tighter affordability assessments and more cautious expectations for future income. Many potential buyers choose to wait, hoping for clearer signals about interest rate direction. This pause in activity contributes to a slower market, where sellers often need to adjust expectations to attract offers. The reduced confidence in rate movements also affects homeowners considering remortgaging, as uncertainty creates hesitation around long-term commitments. The persistence of higher rates influences more than just monthly payments. It reshapes overall market psychology, encouraging caution in an environment already strained by weak growth and rising living costs. When borrowing costs stay elevated for an extended period, they place downward pressure on prices by limiting how much buyers can reasonably pay for homes. A prolonged phase of higher for longer rates could continue to suppress demand through 2026, increasing the risk of further price reductions, slower transactions, and growing disparities between regional markets. This environment adds another layer of vulnerability to an already delicate housing landscape.
Number 4. Weak economic growth and rising job insecurity. The outlook for the UK economy remains fragile, and this weakness directly affects the stability of the housing market as 2026 approaches. Economic growth has slowed, with forecasts pointing toward modest expansion that may not be enough to strengthen household finances. When the broader economy struggles, wage growth often stagnates, leaving workers with limited capacity to absorb rising housing costs. This environment makes buyers hesitant, especially when long-term commitments such as mortgages become harder to justify. A sluggish economy also weakens business investment, reducing opportunities for job creation and making financial planning more uncertain for many households. Job insecurity adds another dimension to this challenge, particularly in sectors vulnerable to automation, restructuring, or government budget pressures. When workers feel uncertain about future employment, they naturally postpone major financial decisions, like purchasing homes or taking on new loans. Existing homeowners also become cautious, avoiding property moves that might increase their financial burden. These choices slow market activity and diminish confidence. As consumer spending weakens, businesses experience declining revenue, creating a cycle that further affects employment stability. A housing market thrives when people feel secure about their incomes, and that sense of security is currently under pressure across multiple industries. The combined effects of a weak economy and job insecurity place the housing market at a higher risk of downturn during 2026. When households cut spending and delay property decisions, sellers face longer listing times and reduced offers.
If unemployment rises, forced sales can become more common,
putting downward pressure on prices in certain regions. A fragile economic backdrop not only affects individuals, but also amplifies market sensitivity to rate changes, regulatory developments, and shifting sentiment. These conditions increase the possibility of sharper local corrections, especially in areas already experiencing affordability concerns.
Weak economic growth remains a major structural factor shaping the housing market's vulnerability over the next year. Number 5. Tax changes and fiscal tightening impacting housing stability. Tax policy plays a major role in shaping the housing market, and the prospect of fiscal tightening has created heightened uncertainty as 2026 approaches. The government faces pressure to repair public finances, and this increases the likelihood of policy adjustments that may influence property ownership. Changes to stamp duty thresholds, potential levies on higher value homes, or stricter rules for second properties can shift buyer behaviour quickly. When households anticipate tax changes, many choose to delay decisions, creating pauses in market activity. These pauses weaken momentum and can contribute to softer prices, particularly in regions already experiencing slower demand. Fiscal tightening affects more than just property transactions. Rising taxes on income or reduced government support in key areas can indirectly impact housing by lowering disposable income for millions of households. When budgets tighten, fewer buyers can confidently enter the market, and existing homeowners may struggle to manage higher living costs. This pressure influences sentiment across the entire housing chain. Uncertainty surrounding future fiscal policy can also lead to varied expectations among buyers and sellers, making transactions harder to complete. A mismatch between asking prices and buyer affordability often results in longer listing periods and increased price reductions. The risk for 2026 intensifies when tax changes align with other economic pressures. If households face higher mortgage rates, job insecurity, and tighter budgets simultaneously, their capacity to absorb new tax burdens diminishes quickly. Investors, who often support rental supply, may reconsider their involvement if property taxes reduce profitability. This could increase the volume of properties entering the market, placing downward pressure on prices. Fiscal tightening interacts with existing vulnerabilities to create a complex environment, where even moderate policy shifts can alter market dynamics. These combined factors make tax policy a key element in assessing the housing market's stability in the coming year. Number 6. Landlord exodus and pressure on the private rental sector. The private rental sector is undergoing significant pressure, making the potential for a landlord exodus a major risk factor as 2026 approaches. Regulatory changes, rising maintenance costs, and stricter compliance requirements have altered the financial landscape for property investors. Many landlords face expensive upgrades to meet energy efficiency standards, while evolving tenancy rules reduce flexibility in managing their portfolios. These shifting conditions can make rental ownership less appealing, especially for small investors who rely on predictable income. When profitability weakens, the likelihood of landlords selling their properties increases, especially in areas already showing slower demand. An accelerated exit of landlords can reshape both the rental market and the wider housing system. When multiple rental properties enter the market at once, supply increases in concentrated pockets, placing downward pressure on local prices. Buyers may see more options, yet many ex-rental homes require repairs that add extra costs. At the same time, the reduction in rental supply can push rents higher, affecting tenants who already struggle with affordability. These dynamics influence sentiment among potential buyers, as uncertainty about future rental conditions can alter their long-term housing choices and delay purchasing decisions during a sensitive period. Looking ahead to 2026, the possibility of ongoing landlord departures creates meaningful risks for market stability across several regions. Investors adjusting their portfolios may continue releasing properties, contributing to slower price growth in areas where demand is already weakening. Prospective sellers may encounter increased competition, particularly if many homes share similar layouts or conditions. Tenants could face tightening rental availability, even as more properties appear for sale, creating an unusual imbalance between the rental and ownership sectors. Such dynamics increase sensitivity to economic shifts, making the market more reactive to changes in interest rates, regulatory decisions, or broader financial pressures during the upcoming housing cycle in Britain.
Number 7. Regional imbalances and overvaluation in the South.
Regional imbalances have become a defining feature of the UK housing market, and these differences play a major role in shaping the risks heading into 2026. While some areas in the North and Midlands still show signs of stable demand, many southern regions remain significantly overvalued compared to local incomes. High price-to-income ratios make it difficult for average workers to enter the market, especially when borrowing costs remain elevated. This imbalance limits buyer activity, slows transaction levels, and places ongoing pressure on price expectations. When a region becomes reliant on a smaller pool of financially stretched buyers, even a minor change in sentiment can influence valuation trends. The South also faces a unique sensitivity to economic and policy shifts.
Areas with high prices react more sharply to interest rate movements, tax changes, or adjustments in lending criteria. Buyers in these regions often already borrow near their affordability limits, meaning that rising costs or reduced confidence can quickly discourage them. Local markets then experience longer listing times, higher numbers of price reductions, and an increase in sellers attempting to move before conditions worsen. These patterns do not always create nationwide declines, but they can trigger significant corrections within specific regions. This fragmented behaviour increases complexity and uncertainty throughout the housing sector. Overvaluation makes these southern markets more exposed to potential shocks in 2026. If job insecurity rises, tax adjustments take effect, or mortgage rates remain higher than expected, buyers may continue to retreat.
Sellers who depend on achieving peak valuations face pressure to revise expectations, especially in London and surrounding areas where affordability challenges are most severe. The divide between stronger and weaker regions creates a two-speed market, where some areas stabilise while others soften. This imbalance heightens the risk of sharper local downturns, which can influence national sentiment and contribute to an environment where caution dominates buyer behaviour into the coming year.
Number 8.
Construction slowdown and developer risk. The UK construction sector has entered a slower phase, and this shift creates meaningful risks for the housing market heading into 2026. Developers are more cautious due to higher borrowing costs, weaker buyer demand, and uncertainty around future economic conditions. When confidence drops, many projects are paused, delayed, or redesigned to reduce financial exposure. Fewer new homes entering the pipeline can support prices temporarily, but it also reduces the variety and accessibility of options available to buyers. A construction slowdown affects the entire supply chain, influencing labour availability, materials demand, and long-term housing delivery targets across multiple regions. Developer risk becomes more visible when sales rates fall below expectations.
Many builders rely on consistent off-plan purchases to finance ongoing projects, and slow sales can disrupt their cash flow. When this happens, developers may offer incentives, reduce prices, or reevaluate the feasibility of planned developments. Such decisions alter the balance between supply and demand. If several developers face similar challenges, the market may see pockets of discounted new builds concentrated in specific areas. These reductions influence nearby resale values, shaping buyer expectations and encouraging further negotiation in a market already affected by cautious sentiment. The slowdown's impact reaches beyond pricing and affects how people perceive long-term market direction. Buyers may hesitate to commit to homes in developments where construction timelines become uncertain. Investors may reconsider involvement in areas where large projects risk delays. This environment creates an uneven landscape where some regions maintain relative stability while others experience reduced activity and shifting valuations. As 2026 approaches, the combination of stalled projects, lower demand, and increased financial pressure on developers contributes to a more fragile housing environment. The construction sector's slowdown amplifies existing market vulnerabilities,
and heightens the potential for broader corrections if economic conditions fail to improve during the coming year.
Number 9. High household debt and financial stability concerns. High household debt remains one of the most significant underlying risks for the UK housing market as 2026 approaches. Many homeowners entered the last few years with large mortgages relative to their incomes, supported by low interest rates that made borrowing feel manageable. As financial conditions have tightened, the cost of servicing these debts has risen sharply. Households carrying substantial mortgage commitments are more exposed to economic shocks, particularly when wage growth slows or living expenses increase. This pressure reduces financial flexibility and increases the likelihood that even small disruptions may create repayment difficulties for certain groups of borrowers. The strain becomes more visible when households face higher monthly costs, either through remortgaging or shifts in everyday expenses. Rising debt repayment obligations limit the ability to save, invest, or maintain spending habits that support local economies. When families allocate a large portion of income to mortgage costs, the capacity to manage emergencies becomes limited. This situation creates an environment where unexpected events, such as job losses or reduced working hours, can lead to missed payments. A rise in arrears or forced sales within specific areas contributes to weaker sentiment and places downward pressure on local prices. Financial stability concerns arise when these individual challenges begin to accumulate at a broader scale. Although major banks remain well capitalized, widespread household stress can influence lender behavior and buyer confidence. Cautious lending, stricter affordability assessments, or reduced appetite for risk can further slow market activity.
Regions with high concentrations of heavily indebted homeowners may experience deeper corrections if economic conditions worsen. As 2026 approaches, high household debt interacts with other vulnerabilities such as higher interest rates, weak growth, and tightening fiscal policy. These combined pressures create a sensitive environment where debt-related stress could become a key trigger shaping market outcomes across multiple UK regions. Number 10. Confidence risk turning stagnation into a downward slide. Confidence plays a central role in the direction of any housing market, and the UK is currently in a period where sentiment remains fragile. House prices have slowed, transactions have reduced, and both buyers and sellers appear cautious about long-term commitments. When confidence weakens, people often delay major financial decisions, creating a cycle where reduced activity leads to increased uncertainty. This environment encourages cautious behavior, particularly in regions where affordability challenges or economic concerns are already present. A hesitant market can quickly shift towards stagnation, making it harder for sellers to achieve expected prices and prompting more price reductions. The risk intensifies when several pressures interact simultaneously. Higher borrowing costs, concerns about future tax policy, and unstable economic growth all influence buyer psychology. When households become unsure about future financial stability, they often wait for clearer signals before entering the market. Sellers facing long listing times may reduce prices to attract attention, which can set new benchmarks in local areas. As more reductions occur, buyers begin to expect lower prices, further slowing demand. This shift in expectations can gradually turn a stable market into one experiencing consistent downward adjustments. The behavior of buyers and sellers becomes a key factor shaping short-term price movements. Looking toward 2026, the greatest risk lies not in a single economic shock, but in a collective loss of confidence that amplifies existing vulnerabilities. When sentiment deteriorates, even stable indicators can appear weaker, encouraging people to hold back until conditions feel safer. A housing market driven by caution becomes highly reactive to news about rates, fiscal decisions, or economic data. This heightened sensitivity increases the chance that a period of stagnation
could evolve into a broader decline if confidence slips further. The direction of the market depends heavily on how households perceive financial stability throughout the coming year. The outlook for the UK housing market in 2026 is shaped by a complex mix of economic pressures, shifting regulations, and changing buyer behaviour. No single factor guarantees a collapse, yet the combination of rising mortgage costs, stretched affordability, fragile confidence, and regional disparities creates a landscape that demands careful attention. These pressures form a slow-moving wave rather than a sudden shock, influencing decisions at every level. From first-time buyers questioning affordability to landlords reconsidering their portfolios. The market is moving through a period where caution outweighs optimism, and this shift alone can alter price trends across the country. While some regions may remain resilient, others could face sharper corrections, depending on local demand, employment strength, and the scale of refinancing challenges. The key is understanding how each of these forces interacts. Markets rarely fall solely because of numbers. They change when people adjust their expectations and react to financial strain. As 2026 approaches, staying informed becomes one of the most valuable tools for navigating uncertainty. If you found this breakdown helpful, make sure to like the video, subscribe for more deep dive economic insights, and comment below with your thoughts on where you think the UK housing market is heading. Your opinion adds real value to the discussion.